Hello there, class. A few of you requested a video or a podcast or something like that for this particular unit. I know it's later in the week. Those of you next year may benefit from this, so I thought I'd whip together something that might be helpful, especially when you consider income statements. So anyway, let me just kind of get to the notes that we've prepared for you and tell you a little bit about an income statement. I don't want to take too much of your time here, but the income statement, of course, is the summary of revenues and expenses as recorded over a period of time. So what we're generally talking about is an accounting period, and essentially that's a year's time. And we're measuring the amount of profitability, say from the 1st of January through the end of December. So that's basically what we're talking about in that case. That can be contrasted against a balance sheet, which is prepared for one moment in time. And as this slide illustrates, a balance sheet can be prepared for January 1st, on January 1st, and also for December 31st of the same year, or any time in between as well. It's just one period of time. The income statement measures the profitability or the revenues and expenses throughout that whole period. So that's the major difference between the two. They do measure different things as well, as you found out with the balance sheet and as our discussion goes ongoing about the income statement. Now, revenues should be recognized as soon as the commodity is ready for sale, whether or not it's actually sold. And that's an accrual concept, and something that we've covered in ag records and more than likely, hopefully, in your accounting class if you've taken it so far in your ag business experience. That way, we can measure the gain or loss on the sale of we also need to measure the gain or loss on the sale of capital assets. That's like if you have a tractor on the books, it has a book value of say $5,000, but you actually don't need it anymore and you sell it for $6,000, then the gain would be $1,000, and that simply becomes ordinary income within your income statement. Okay. The whole 6,000 doesn't. You've already expended the 5,000 portion of it. And then, of course, the expense side of an income statement are all those things that it takes in order to produce the revenue for an accounting period, and those should be included on the income statement. Of course, if we're talking about livestock, we're talking about feed. We're talking about veterinary expenses. We're talking about all those major expenses that you are incur as you produce those commodities. The income statement format can change somewhat, but the generalized concept of that is that we'd have total revenue clear at the top, less your expenses. That would equal your net farm income from operations. The expenses being what it takes to generate that revenue, okay, as we explained before. Plus or minus the gains or loss on the sale of capital assets, and that equals the real net farm income. Net farm income, okay, if you're not familiar with that term, is the profit from this particular enterprise or this particular operation. And that's what we're trying to get at as far as an income statement. This one might be a little bit more familiar to you as far as a format, and we actually break it down a little bit more. And this speaks somewhat to your assignment, especially at the very top. We've got cash crop sales and we have cash livestock sales, and if we're producing those in a particular accounting cycle, then we record those. But we also record inventory changes in crops and livestock. And probably the most simplistic one that we can think of, say we go into the accounting season, January 1st, and we have 500 tons of hay. Now, we may feed some of that and we'll expense that out, but at the end of our season, we may have 750 tons of hay. So what we really have to do, we could have sold that difference um, during that accounting cycle or that accounting period. So what we need to do is reflect that within the income statement because we have a real change in inventory of 250 tons of hay. So that would be the change. And in that case, we would actually have a positive influence on the revenue side of this income statement. And that this speaks directly to your assignment for this week in the fact that if you have a positive change of an inventory item, that's actually a positive change to your revenue, thus a positive reflection to your net farm income. Hopefully that makes sense. The value of that 250 tons of hay, it might be $100 a ton, so we would have $25,000 change in crop inventory for that particular item, and we'd have to increase the uh, the revenue side of our income statement for that year. So that's a real kind of uh, uh, thing that we would actually adjust our income statement for in order to have it reflect a real accrual profitability. And if you've been in my record keeping class, you've heard me talk about the accrual versus cash types of looking at things. The only way we can look at true profitability is to actually keep an accrual set of books. And that's one way we would do it. There's a couple other ways as well. Down in the bottom there of our income statement, we talk about the gain on our capital items. Now, we're not in the business of selling tractors. We're not in the business of selling um, breeding bulls, those kinds of things, if we're a commercial outfit. And you may be, but I'm just taking for an example. So, but these things, these depreciable assets that we use to generate revenue, when we finally decide to sell them, once we've either replaced them or they don't have any more usefulness to us, we more than likely will sell them if we don't put them in the junk heap out in the drawer or something like that. But if we may have a value on the books, an example of that would be that we have a tractor that's worth $5,000 on the books. We sell it for $6,000, so we actually have a gain on that capital item sale of $1,000. I mean, we could have lost too. Maybe we sold it to the neighbor at $4,000. So that would be a loss on that sale of capital items as long as it started out as $5,000 on our books as a book value. Okay, so that definitely affects the net farm income when we inject that into our income statement, thus actually reflecting true profitability to our operation. I'm going to go through some of these things a little bit faster. I think this slide kind of, if you'll just study it a little bit, um, it it will tell you a lot. I will speak a little bit to depreciation expense. Depreciation is actually reflected on the income statement. It is not a cash expense. We pay for an item, and again, we can use the items such as a tractor. Say we pay just for to keep it simple, $10,000 for a tractor, and we're going to depreciate that over 10 years with straight line depreciation, then and we're going to have a salvage value of 0 at the end of that 10 years, completely using it up, then we would depreciate each year $1,000 on the income statement. Does the $10,000 when we expend it show up on the income statement? No, because we're taking $1,000 per year over the 10 years of that asset. So that tractor will be reflected in the income statement on the expenditure side as $1,000 worth of depreciation per year for those 10 years. Hopefully that makes sense to you. It shows a true profitability. We don't use that whole tractor up over 1 year. So we wouldn't want to expense it just in one accounting cycle or year. So that's the reason that we do that. Depreciation definitely is shown on the income statement though, and it is reflected in true net income computations. I'm going to let you kind of take a look at that, and you can reflect on this slide here. This is just where we talked about here. We had from those computations of the past slide, we had inventory change in the crops of a negative $8,000, but market livestock of a positive 1,700. So that's reflected in our total revenue, and thus our bottom line, our net income is changed because of that. It's a true picture of our production and our profitability within the ranch by taking that inventory change. Okay, I think that kind of covers what the main gist of what I want you to understand without, uh, I mean, you can continue to read these slides and get something from them, um, and work on the homework, and we'll leave it at that. The income statement is a very important statement because sure, most of us in agriculture understand the fact that there's going to be periods of time when we just, being price takers, we can't even pencil in a profit. But we have to have sustainable profits over time in order to stay in business. We can't rely on the equity that we built up in our operations for very long, or the business basically becomes bankrupt over time. So anyway, hopefully that helps, and give me your feedback. I appreciate it, and if you have any questions, then give me a call, would you?